sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good afternoon and welcome to Closing Bell. We're starting a little early because it's been that kind of a market. Relentless selling. It started from the morning. It hasn't stopped now. And it's selling that's encompassing all parts of the market. The only sort of saving grace is that we're not alone. A lot of the Asian markets have fallen. But I think what's happening here right now is pretty severe, to say the least. I'm Surabhi Upadhyay. With me on the show, as always, Rima Tendulkar and Nigel D'Souza. Hi, guys. What an afternoon.
What an afternoon, but Europe is not falling. The CAC and the DAX are actually up close to about 0.5%. The FTSE is flat, but with a negative buy. So it's, at least as of now, we're pretty much falling alone. Asian markets have shut.
Well, that's right. You know, if you look at the trend from morning itself, India has been underperforming its Asian peers, and the futures, the European as well as the US futures, both of them are indicating a positive opening. So there was some kind of talk with regard to that virus. However, the ministers come out and said there's no real reason to worry. So it appears the quarterly updates that have come in, particularly from the banking names, that's what's weighing on the markets. You know, and that's clearly evident from the PSU banking index, which is getting smacked back in today's trading session. The breadth of the market is the most disappointing part of it, because you have 10 stocks that are declining for every one stock that's advancing. The breadth of the market is indicating the kind of selling pressure that we're seeing, and those lines have just been drifting apart from the word go. And hospital and diagnostic stocks are gaining. In case there is some kind of panic on the health front, that's what it's indicating. So that's why you have some of these stocks that are doing well. And, you know, the important part is we've broken the 200 DMA, and now we're trading substantially below that as well, you know, particularly for the Nifty bank. So that's going to be the important point. The 200 DMA was the important support when the markets were breaking down. Now, in fact, it will become a bit of a resistance on the way up. The bulls will be hoping for some kind of a pullback towards, the end of trade. But as things stand, it's firmly in favor of the bears as we speak. 90 minutes to go. It appears the FI action as well has returned. So I think we could be bracing for a rather larger sell number as well.
Absolutely. I was just coming to that point. You hit the nail on the head, Nigel, because maybe at the margin, this virus fear became another excuse to sell. At least not that foreigners needed any excuse to sell India. They've been doing that relentlessly for the past many weeks. Even in fact, if you look at the last 5 days, the numbers are on the screen. On Friday itself, the net sell figure from the FPIs was in excess of 4,000 crores, 4,300 almost. So let's see what today's number is going to be like. And it's very clear that whatever domestic support is coming in from domestic institutions, mutual funds, it's not enough to offset the declines. I just want to highlight that PSUs in general were leading the fall. PSU banks and other CPSE stocks as well. But it's now spread far and wide. The bank nifty is weak. A lot of consumer stocks are reacting quite negatively to the updates that have come through. There's no support. Even IT is not able to offer any kind of support. And to complete the point that Nigel was making, healthcare and diagnostics, it's a sentiment trade that's playing out right now. So you look at stocks like Thyrocare, look at Dr. Lal's, Metropolis, or even look at hospital stocks like Rainbow Medicare or even Apollo Hospitals, among the larger ones. That is where the immediate sentiment is, at least on an intraday basis today, Rima.
The small cap index, by the way, is down more than 3%. The mid cap index is down close to about 2.5%. And of course, the advanced decline ratio, right? 1:10. Even the other sectors like metals, realty, auto, across the board, these are cuts of about 1.5% to 2% coming in for the key indices. Tech is the only index, and that is flat. There is no sectoral index, which is currently in the green right now. But let's find out how you can position your...
we'll do that in just a bit. We'll do that in just a bit. But the other issue is the currency. And, we've been flagging off the weakness, making multiple lows last week. And today, the level is now gone above 85.80. So we have Lata joining in to put this in context. And then we'll get to, of course, the stock trades in just a second. But Lata, you tell us, it's been a bit of a free fall for the currency. What have you been picking up from your sources in the market?
Well, it wasn't such a free fall last week. We did see the Reserve Bank come in at several points, and the expectation in the market was 85.80 will be held for now, because at several points, as the rupee was approaching 85, 79, 78, you could see the supply of dollars At least that was the story last week. A few things have happened since Friday. One big thing that turned the domestic sentiment is that number which we've all been talking about, 4,227 crore of selling. You know, there was that one day of positivity when the year began, and there was a feeling that fresh allocations are coming. All those were wiped clean, and how when you saw that, 4,200 crores selling bang on the first proper working day for the markets, when probably the trading was a little fuller in terms of volume. But a bigger turn came in the currency markets in the yuan. It was for about 2 weeks, the PBOC appeared to be defending 7.2829 on the yuan. And on Friday, we suddenly saw that 7.3 and then onward, 7.31 come in. So it was to be expected that on Monday, the rupee will have reverses, that 85.80 that was being held will give way. Or the offshore yuan, the one traded in what you call the CNH, that had already gone past 7.33 and started trading at 7.3536 on Friday itself. So those reactions were all expected to come in the Indian markets as well on Monday. That 4,227 crore number just turned the tide. And, once you see the force of all these currencies, the Reserve Bank normally lets go. And that's what it appears to have done today. The Chinese yuan also is, the expectation in the market is that it can go even up to 7.4 towards the Trump swearing in. The sentiment is pretty negative over there. And as you can see, all the global factors, the ecosystem itself was against Indian currency as well as EM currencies. Strong dollar index, it was almost 109. US yields at 4.62, the 10-year yield. And then, of course, the crude prices also just unusually going above 75. We have gotten used to 70 to 75 for the better part of last several weeks. So all that combined, but my sense is I bring good tidings for the last 1 hour. The dollar index now has moved towards the 108.7 mark. It's now a distance from 109. So that might create some kind of stability in the currency market. It is never one-to-one currency and equities. But my point is that perhaps the worst of the selling for the moment is over, and people will want to see what is the new equilibrium in the currencies. Like I told you, there is a feeling that the yuan has more fall to happen.
Okay, all right. Lata, stay on. In fact, maybe you'd want to take some questions to our next guest as well. We have Mitul Kotecha of Barclays joining us on the phone line for a quick view on what's happening here. Mitul, thanks so much for taking the call. And, we're all watching both Indian equities and the Indian rupee weaken. And maybe to an extent, like Lata also explained, the fortunes of one are tied to the other. What is it that you're hearing on the currency? And I don't know, I'm not trying to, drive up any conspiracy theories, but is this a little bit of maybe an orderly depreciation that right now India seems to be okay with, given what's happening across our border with the Chinese yuan also weakening in the last couple of weeks?
Yes, it's a great question, and something that we have been highlighting for some time, that India is going to be very sensitive in terms of RBI to movements in the yuan, given the widening trade deficit with China, the increased focus on manufacturing and competitiveness with China, and the need for some investment potentially from China to help build or push into the manufacturing base to a stronger level. And I think the fact that, as you were talking about earlier, the fact that dollar yuan has broken through 730 may not have gone unnoticed from the RBI. And I think there's another factor here as well. We do have a new central bank governor, and we yet got to hear about what his policies are on the rupee, but we knew that Governor Das was quite interventionist in his policies, to say the least, and capping volatility. And we may be seeing a sea change in that, although, again, we've had no confirmation of this. But the fact that we've seen a bit more of an orderly decline in the rupee, which, to be fair, is matching some of the moves in other Asian currencies. So it's not that the rupee is depreciating much more rapidly, but at least for now, it's at least a sense of trying to maintain some level of competitiveness. So, as long as the dollar remains strong, as long as other Asian currencies, particularly the yuan, weakens, it does suggest more upside for dollar INR.
Okay. No, it's not so much a sea change in policy that the governor will bring, as much as a sea change in the ecosystem in which he has to operate. New realities and Trump swearing in. But Mithul, the Indian market, the chatter is pretty loud that the yuan may go all the way to 7.45 even before Jan 20th. Do you all have that kind of view?
That's again, the pace of the move more recently has suggested that there's more weakness in prospect. But our view is that we think that China will wait to see what the shape and magnitude of tariffs that President Trump will enact upon China. And it's unlikely that we're going to see a massive depreciation ahead of some clarification on this stance. And, we just look back at 2018, it took around 4 rounds of tariffs before we saw a significant sharp depreciation of the yuan. I mean, it was weakening, but not to the extent as you would have expected. And I think the point being is that, China may keep its powder dry. We may see the extent of tariffs, and then we may see a deeper weakening of the currency. Our forecast is 750 by year end. So, we still think there's a bit more of a gradual move. That said, and the big caveat here is that if we see Trump enact 60% tariffs on China, we would not rule out potentially a move to around 840 or above in dollar CNY. So a lot depends on the magnitude of tariffs that will be implemented.
Okay, so then your base case is that the yuan remains around the current levels, okay, 7.3 to 7.35 up until Jan 20th, and then take it as it comes. If that's the view, what's the view on the rupee? Is it very, very incremental? Is most of the depreciation over for now? What are the Jan end levels, March end levels?
Yeah, look, I think it's unlikely that the rupee suddenly drops very sharply from here. I think the dollar, already there are signs technically that the dollar has lost a little bit of momentum into this week. I think there is going to be a wait and see ahead of the inauguration. This week is some key numbers in the U.S., and you have the Fed FOMC minutes, and you have the U.S. jobs data, and I think that will also drive direction. So it's hard to see this move accelerating from here. But again, look, we've already passed our key levels of forecast. We were forecasting 87 on dollar INR by end of this year. We've already moved very rapidly towards 86. So moves are quick here in this environment.
So Mithul, are you likely to then, revise that, forecast in any way, or will you also wait for the 20th of January? I don't know if we'll have all the answers by the 20th of January. That's only the beginning of the policy announcements. I mean, the actual tariff policies, the shape and form they take, that'll probably take some more time to become clear. So in the interim,
Trump promised some 10 orders or something.
On day one,
number of orders on day
25
one.
executive orders,
25 orders on day one.
Yeah.
So we don't know if he delivers that, but I mean, since you said you were looking at 87 by the end of the year, now we're already close to 86. What's your latest forecast?
No, look, our forecast hasn't changed, but clearly we are monitoring events. And you're absolutely right. Look, we may not see... Look, firstly, Trump has already sounded fairly aggressive, right? It may mean on day one we may see some very aggressive announcements. Doesn't mean we'll see those implemented. And, there's some gamesmanship here. But the reality is that we're probably going to see something fairly aggressive in the initial announcements from Trump. And I think that may also have an impact on the market. Another question is how much is in the price. So we will wait to see actual implementation as well. So you are totally right. We may not see, the extent, or it may take some time for tariffs to be implemented, and then we'll see a bigger impact. So, for now, we're keeping our forecast as is, and we'll monitor events as is most people to see where things are. And obviously, a lot of this is unpredictable at this stage, but we are trying to assess what happens in a couple of weeks' time, at least the initial focus on the inauguration.
Okay. Any numbers on the dollar index itself? Is there a chance that it is, by the rumor, sell the news, that actually after Jan 20th, the dollar peaks off? In any case, your levels?
We haven't got any forecast levels here. I think we've already seen if we really look at the chart here, since the end of September, we've seen dollar index move from around 100 to almost 109, a very, very rapid move. We are still very constructive on the dollar, so we don't see, even if we see a pullback here, it looks like it may be temporary. So our view remains fairly constructive on the dollar. But like I said, I think we will wait, see what happens in a couple of weeks' time. We'll wait to look at we're all very much data watching. We'll see whether the payrolls shows any sharp moderation. We'll see a lot of Fed comments this week, including the FOMC minutes. So we're going to gauge a lot of this for further direction. But at the moment, there's very little to suggest any sharp turnaround in this sort of constructive dollar view, bullish dollar view that we have.
And just a final number, if you can, on the US 10-year yield, 4.62 is also a peak.
Look, I think in terms of 10-year yields, what we've tended to see is we've already moved fairly sharply higher. Our U.S. rate strategists would seem to be suggesting a lot is in the price in terms of yields. We will also wait to see the extent of fiscal expansion coming through, and it does look like, even with a red sweep, that President Trump may not be able to get through all of what he wishes for in terms of fiscal easing, and that may at least temper some of the sell-off in U.S. rates and U.S. yields. So for now, we've already moved a long way. We would argue a lot is in the price in terms of the U.S. Treasury market.
Okay, Mitul, thank you very much indeed for joining us and giving us that perspective, which I think is important, that a lot is already in the price. I mean, it's 7.5 for the yuan and 87 for the rupee for the year end. So at least in the near term, it looks like the move, a large part of the moves are over.
And this week, the key data points to watch from the US. On Wednesday, you've got the ADP data. On Thursday, the FOMC minutes for the December meeting, plus the JOLTS data. And then on Friday, the all-important non-farm payroll data and the unemployment. And that will test the strength of the US economy, the dollar index, and where yields head. Thank you, Lata and Mitul, for joining in. We will slip into a very short break with the news. Still down 400 points in the Nifty. Sanjay Parekh from Soham Asset Managers will join in on the other side.
Welcome back. Well, a mild pullback is what we are seeing from the day's low. A few stocks are seeing some kind of a bounce back. You have Tata Consumer that's holding strong in an otherwise wobbly market. Kotak Mahindra Bank actually has cut its losses a wee bit. SBI Life as well has cut its losses a little bit. So I think some of those stocks are bouncing a wee bit from the day's low. The good news, at least as of now, if you're looking for some good news, is 23,600 has been defended as of now, at least. Let's see whether or not we can see a further up move in the last 60 minutes or so. Sanjay Parekh, though, joins us on the show to help us out, founder and CIO of Soham Asset Managers. Hi, Sanjay. Good afternoon. Good to see you, Ben. Happy New Year. It's not too happy start to the week, though. But what are you making of this fall? I think it's an India-specific problem, right? If it was any kind of fears with regard to the virus or if it was a global issue, then we'll have other markets as well lower. But for the time being, it appears that India is under pressure. So what are you making of this fall? And more importantly, you're sitting on some cash, deploying or waiting by?
Yeah, good afternoon, Nigel. So, I just earlier you all covered on the currency piece and, if Trump were to be aggressive, how would the yuan behave? And that would have ramification again on rupee dollar. So that is certainly playing out. Of course, we don't know about this new virus, I don't think so. But there may be a little bit of jitters, But leaving that aside, we clearly have to watch what happens on 20th. What happens to yuan, dollar index, they do matter to our emerging markets and for us. RBI has been defending rupee, but there is a limit to which it can do. It's been pretty aggressive defending rupee at a level. So, and it does matter if the outlook on rupee is towards depreciation, for new flows or even for them FIIs to sell off. So this could be an interim measure. I think besides this, coming to domestic piece, our results also are not in our favor. If our Q3 numbers were better, it certainly could have been a positive scenario to counter such global issues. But a quarter three, as we see top down, and initially we're going to see previews started coming in. But if, right from banking, which used to do well, would have a 10.9% credit growth, and there's a deposit cost pressure, a little inch up on credit cost. So certainly numbers are not going to look great, whatever initial previews that we've seen. And so will be for cement, where there will be a minor increase in EBITDA per ton, but still that full pricing power that we need to justify the valuation is not there. Then comes auto. Auto also, you've seen volumes. Maruti, we saw 1 month being good, but overall auto is still weak. CV is weak. Capital goods, surprisingly, still we're not seeing spend coming from the center. And the state, certainly because of those populist measures, have diverted some amount of funds towards those schemes and not in capex. So,
right. So Sanjay, just to go by what you're saying itself, we are in uncertainty with regard to President Trump. There is some kind of nervousness, which shouldn't be a big event with regard to that virus out there. And also the earnings season will be a little bit disappointing. So given these headwinds, what will you do? What is the current level of cash you're sitting on? And will you wait by since there are uncertainties in the future, or are you gradually deploying? If yes, in what sectors?
Yeah, so we are at 7% cash, and clearly cash is coming in because we had some commitments which we had asked to gradually get us those funds, and as we are getting it, our cash levels may marginally go up. So what we're doing is, I'll tell you the nifty view, our earnings view for 25, 26 is we will be more like 1,200 rupees. It's too early for 26, 27, but broadly, if we were to end 1350, then I don't think we should be valued more than 20 times. So for 25, 26 at 1,200 at 20 times is 24,000. But as we look at 26, 27, certainly there's an upside. So what we think is more like 10, 11% annualized returns are possible. We very strongly feel that the price correction from another 0.5% or 1% looks difficult. You can never say never, given this global uncertainty. But the time correction will happen. So that is where our strategy is: keep a margin of safety. You'll get your levels. You have enough opportunities now in Nifty as well. And in mid and small cap, have a much higher margin of safety, because there the fall could be much sharper. And that's where we'll gradually deploy our equity, because we're not so bearish on the larger caps, on the price front.
Sanjay, are you disappointed by the banking updates that we've got so far, either on banking, NBFCs, PSUs? What has disappointed you, if at all?
Yeah, so Nima, one is before the result preview, also the credit growth was showing up in terms of 10.7% growth. That is clearly, rightly, RBI being conservative, that please keep your credit growth in sync with deposit growth. And deposit growth, we know pressures because of several reasons that we know. So that was the first piece. And hence we've seen even the larger banks calibrating the growth, X of HDFC Bank. HDFC Bank, we always knew that it's a phase which they'll have to pass through, and they've been very vocal about the slowing of advances growth. So that is a transition phase which will continue for a while till they reach a CD ratio maybe around 90, which is it's going to take some more time, maybe 3-4 quarters. So that was known. But even other larger banks, we are able to see that growth has been going to be calibrated. A little bit of deposit cost pressure, not so much on NIMs, but credit costs could marginally go up where the credit cards or microfinance piece is higher. So that's where we are. On the positive side is again, the valuations, where I think is all known. We'll see more previews. So as we see that it's all expected, we have to see whether it's in the price. And that's where we believe that some of the companies, like if you see Axis Bank, at the peak you saw at 1370.80, now it's 1060. So all of them, the larger banks, I think, could have some more fall, and then they'll throw up real opportunity. And we are holding all of them. All the larger banks, we are there. So we are positive because of the valuation.
Okay, all right. Sanjay, just hang on. We'll try and get in Abhishek, because he's been going through a lot of the updates that came in over the weekend. I think he told us 23 at last count. Those are the number of, Q3 updates that came in over Friday, Saturday, and Sunday. And a lot of the stocks have been reacting today. In fact, to talk about one such name, PSUs in general, PSU banks are leading today's financial decline. But one of them that has been the hardest hit is actually Union Bank of India. It's how much is it down by? Yeah, it's still down about 7 or 8%. So it's been quite a telling story for Union Bank today. Even BOB is down. For Union Bank in particular, deposit mobilization has almost stalled. If you look at it, if you're looking at it quarter on quarter, then the deposit base has actually declined by 2%. So that seems to be a bit of an issue. Then you have larger banking names as well. HDFC Bank, for instance, for them the growth in advances, that's been fairly weak at around 3% or so. And for HDFC Bank, yes, they're mobilizing deposits. Deposit growth is 15-16%. But then what kind of deposits? Term deposits, for which the bank has to pay a lot more interest. So those are some of the, I think, the issues that the market is grappling with today. In fact, we have the man with us now. Abhishek has joined in. So let's ask him. Abhishek, lot many updates have come in. So focus on some of the key highlights that stood out for you.
Well, 21 business updates did come in from the close of market on Friday evening to Saturday night. So PSU banks, they are weak in trade today after the Q3 FY25 business update. It's largely due to the loss of market share in deposits. Take a look. Union Bank of India, the growth of deposit is just 3.8% on a YOY basis and a decline of 2% sequentially. For Union Bank of India, they have been losing market share in business momentum for a long time right now. I don't remember seeing them gain market share even for 2 or 3 quarters in a row. Indian Bank 7.3% growth plus 1.3% sequential growth in deposits. Bank of Baroda, the growth rate has actually slowed down in deposits. So this time it's at 2.1% quarter. Last time it was 4.3% sequentially. Even the loan growth has turned out to be weak on account of the fact that deposit momentum is weak. So loan growth for Union Bank of India is less than 6% YOY and about 2.2% sequentially, while Indian Bank, it's close to 10% and 1.45% sequentially. For Bank of Baroda, again, the fall has been seen with respect to loan growth. It is at 2.5% quarter-on-quarter this time around. Last time in Q2, the loan growth was around 6.6 to 6.7% quarter-on-quarter. Now, some of the lenders that are weak in trade post Q3 FY25 business update, if you see soft or weak quarter update coming in from them, IndusInd Bank, their deposit growth is at just 11% YOY, perhaps one of the weakest in last 16 quarters, and it's down 0.75% sequentially. Perhaps the first time you are seeing decline in the deposit momentum on a sequential basis in last 19 quarters. Suryodaya Small Finance Bank over there, the gross NPA ratio has inched up to 5.5% from 2.9% in the previous quarter. Bandhan Bank, they have also lost out on deposits. Deposits have declined by 1% on a sequential basis for them. L&T Finance, their rural business momentum has turned out to be weak. If you take a look at the rural disbursals over there, it's declined more than 16% YOY and more than 15% sequentially. Back to you.
Okay, all right, Abhishek, thank you very much for that. Those are some of the key updates that came in over the weekend. Sanjay, so, a broader question then, what else? Till there's clarity on what's happening with the market, till this FPI selling stops, the rupee stabilizes, there's too many bigger issues right at hand. The question is, right now, you are getting more favorable prices across the board, pretty much. So what would you buy? Which are the relatively safer areas that you're looking at?
I think, first, Abhishek covered it really well. But our strategy, I think, you rightly said that we'll not get great prices and great news. In fact, we always, in my earlier avatar also, when FIs were sellers, that was the best time you could buy these HDFCs of the world. Then HDFC was listed. And it was a classic trade to contra to their selling. And it works because MSCI, HDFC then was the largest weight. So here again, I think, our structural advantages remain. We cannot forget that all our balance sheets are strong. And by and large, barring some balance of payment issue that we may have, and still I think we are in control, overall, we are in all in good shape. So with that, some of the businesses, be it financials, in the larger banks that we like, both in the private and the PSU space, and even in capital goods, if we get the right levels, we would be participating. And now, as I said, you will now get a lot of choice in Nifty. Of course, we're not there in FMCG. Pharma, we have mild overweight. We will look at a stock at a price. And then certainly, broadly domestic, be it logistics, at a price, each of them would look better. But I don't think government will, ad infinity, stop spending. So once you see them spending and you saw the projects being announced, so each of them the potential to consume cement. So we are very, very confident that you'll see that spend start coming through from Jan till all throughout. And even the budget could be pro-capex, very, very likely. And that's where, because of this global uncertainty, if we are getting the prices right, it's better to do a bottom of stock picking, but slowly and gradually, what I think, over the next 3 to 4 months, because we get time to buy, you don't have to rush up.
Okay, all right. Since you mentioned cement a few times, Sanjay, I just keeping an eye out on Nuvoco. Today, the stock is more or less steady, while all the other cement stocks are actually lower. I think the street is sniffing that maybe there could be some kind of inorganic growth. That is, Nuvoco goes after one of the smaller assets. Let's see whether or not, it's in the offing. But the stock is actually outperforming the rest of the space. So we'll wait by to see how exactly there is some M&A action that involves Nuvoco. Keep an eye out on that. Well, Sanjay, final question. You've been quite bullish on select metals like Vedanta. That's not yet played out. You're still holding on to that position. There could be a lot of value that could get recognized. But for the time being, the markets are in a tizzy.
Yeah, I think globally, you've seen LME, all the metal prices coming down. That's to do with Chinese uncertainty led by what Trump could do. So I think it's a transition phase. We at least feel there's a lot of value in Vedanta. As earlier discussed, there's already 43 rupees dividend in the kitty. And during such price falls, those dividend really help. You don't realize, but that 43 rupees, and if your entry price is better, is actually a fantastic outperformance. And that's where we believe, and you've been buying Vedanta, as earlier said, from 318 till even at current price. So we are pretty confident and positive as the demerger happens. there will be a focused, all the focused companies, and there will be a value discovery which will be much better than the current price. The SOTP of each of them will be significantly larger, we believe. And also the global deleveraging is helping them, and they are on that path to further get to $3 billion. So that will again help from today at, I think, little less than 4.5 times EV/EBITDA. It can go to 6.5 times EV/EBITDA.
Got it. All right, Sanjay. Thanks a lot for joining in, giving us that view. So select stocks would be a good opportunity to get in. Appreciate you joining in. We'll keep chatting with you as the course of the year does progress. By the way, keep an eye out on the Nifty. That little bit of a pullback that we saw, that got sold into. Now the market's again making fresh lows of the day. Tata Motors, that did very, very well on Friday. It's unwinding some of those long positioning. Grasim is under pressure. Crude oil prices have spiked up. So you have OMCs under pressure, Brent as well as HPCL. Riva, you want to name a couple of stocks as well, I think.
No, I just wanted to quickly highlight some of these IT stocks. So the Nifty IT index is relatively outperforming, but there are two of them which are managing to hold up in the green. One of them is LTIMindtree, because Jefferies has upgraded it to a buy, target price at 66.50. They're saying it was one of the worst performing stocks of last year. The stock had fallen 10%. There were EPS downgrades. The stock went through a PED rating. But now, after this correction, the valuation is attractive. It's a 30 times forward multiple, and it has a very high exposure to North America discretionary spends, and therefore it's a recovery play. And the other one is Emphasis, where Jefferies has initiated coverage with a buy, target price 34.60. Again, the key reason is it has about an 80% exposure to America, and BFSI is 60%. And these are the resilient pockets in the global economy. They will recover going into next year, and therefore Emphasis will also benefit. And they're saying because of that, it's one of the IT companies which will give you a double-digit EPS return. Everyone is chasing growth. And according to Jefferies, Emphasis should give about a 14% EPS growth over the next 3 years, and that's driving their bullish outlook. But get into a break on that note. As we do that, here is some good news for all our viewers, because India's business news leader is now just a click away. We're introducing the all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store. Welcome back. Below 23,600 on the Nifty, 426 points down. One of the levels to watch will be last week's intraday low on the Nifty, which was 23,460. From there, we rebounded to 24,200. It was about a 700, 800 point rebound. We once again retraced very significantly. So 23,460 is a level you should watch. In fact, let's get in Mitesh Thakkar now with a few closing strategies. Mitesh, big, blow for our markets today. Big fall.
Yes, very big. And I think, what's important is that while the Nifty is yet to break the last week's low, I think the Bank Nifty has already done that. And that's where the pain is coming from. Today it broke the last week's low. It's also broken the low which it made in November. I think at least on a closing basis, the low was 50,072. So it's trading below that right now, about 300 points. So that could be another breakdown. It's also breaking this 200 average and the weekly averages and weekly trend line and pivot. So I think it is the banking index which is clearly showing signs of further pain. And that, of course, will have an impact on the Nifty because the banking index or space does occupy significant weightage in the Nifty. So I think look at, getting into short positions on the financial names or stocks which are breaking down. For the Nifty, I think, the November low on a closing basis around 23,350. So that is the level which I'm watching. We're about 200 points away from that. That could be tested. If that gets taken out, then we'll look at further declines. But for the timing, I think it's the Bank Nifty which will be more in pain. On the stock side, I have a sell on Tata Power, which I would recommend selling with a stop at about 387 for targets of 355. And Balkrishna, in fact, the entire tire pack is looking extremely weak. They are all negative, and Balkrishna has had a fresh breakdown. So sell here with a stop at 27.50 for targets of 26.30.
Okay, all right, got it. Mitesh, thanks very much for those calls. We'll come back to you in just a bit. Again, quick check, full tilt on the market, 450 down on the Nifty. So there's not much respite, 23,555. By the way, last week's low is close to 23,460. We've already lost, all the key moving averages. We've been trading below the 200-day moving average as well. And now the bulls will hope that at least last week's low does not break. Let's see. It's still about 100 points away from where we are. 3% drop on the Midcap index. It's a crunching fall, and the Bank Nifty is down about 2.5% as well. I think in the next couple of minutes, we'll be speaking to some experts to try and grasp exactly what the situation is with this virus. Before we do that, let's actually hear out what different functionaries of the state government and the union government, what they have been saying as well. Now, here is the latest. The Indian Council of Medical Research has confirmed 2 cases of the human metapneumovirus or HMPV in Karnataka. However, the Union Health Ministry has affirmed that there has been no unusual surge in influenza-like illnesses or any other respiratory illnesses. The ministry has said that it is, of course, keeping a close tab on the situation in China, and it says that India is well equipped to handle any unusual rise in any sort of respiratory illness. Listen in to the Karnataka Health Minister, who says there's no cause for panic.
I don't think we should be pressing the panic button because HMPV is not a new virus. It is an existing virus. And the statement, the way report has come out that this is the first case of HMPV in India, which is not true because HMPV is an existing virus and certain percentage of people do get affected by this virus. And it is not something new. It's been there for a long time and it causes common symptoms like cold and for maybe flu and cough. And then it's a self-limiting virus, so it goes away after some time. And I don't think we should be calling it the first case. That is a wrong way of reporting it.
Okay, so that was the Karnataka Health Minister. Let's get in 2 experts from 2 different companies in the diagnostics and healthcare space. We have Dr. Abhiroop Sarkar, Director Lab at Suraksha Diagnostics. We also have with us Dr. Niranjan Patil from Metropolis Healthcare. Thank you very much, gentlemen, for joining in. So I think we're just trying to understand the nature, the severity of the issues at hand now. There are different reports, not confirmed by ICMR. There's another report indicating that maybe there's a confirmed case in Gujarat. But again, it's not been fully confirmed by ICMR. Dr. Patil, let me come to you first. How should we look at this? Is this virus perhaps another strain, another virus, much like what we saw in COVID. And as far as testing is concerned, has testing started? Is it similar, tests like what we had during COVID? What exactly is the situation on ground?
Yeah, so HMPV is a different species of virus. Okay, like coronaviruses are different species. So this is a different species of viruses. They're more like your RSV group of viruses. And we have the testing in place. In fact, we have been testing this by using US FDA approved and CE approved test kits, which basically are kind of syndromic approach where it not only tests for the HMPV but also tests for other flu viruses and RSVs. And we have been testing this successfully, and our test is CAP and enable accredited. And the turnaround time is also quite short for testing. So I would not say there's and we are also ready with if we want to test on a scale. For example, if there is an outbreak, a major outbreak, then we are ready for that. But nothing to worry as such, as it has been emphasized. It is a self-limiting virus, but it is very important to test and be sure about what the virus is out of the different viruses, because of the climate currently, because of the festive season, and because of the international air travel. So instead of having some subjective approach, we should have an objective approach. Is my take on this. Okay,
not a big threat is what I'm taking away from that, Dr. Patil. Let's get in Dr. Sarkar as well. Dr. Sarkar, do you concur? Basically, we're worried about, is this something that, is it a routine disease, a flu or viral, or is it something more that we should be worried about?
No, it is just a routine common cold virus. So it has been there for decades. In India, there has been thousands and thousands of cases over last few hundreds of years maybe. We started detecting it for last like 3 to 4 years or so, and we almost every lab is like we also test for this test as a syndromic approach, as Dr. Patil has also said. And it is not a new virus, so it has been tested regularly and tested positive also regularly. But we have to be cautious in that also, because we do not know if there is any new mutation or anything genetic changes there in HMPV. But currently, whatever what are the news now currently, there is no genetic mutation or anything has been reported by China or any bodies. So currently what we are seeing is just a common cold virus, and it is also easy to detect.
Gentlemen, that's very reassuring to hear that this could be another virus. I mean, any sort of common flu or cold sort of a virus. But then why the need to test? I think that is where suddenly public attention is drawn when cases are being confirmed, when testing is happening. If this is a routine virus and if it's not a very severe sort of strain, then why the need to test or to start reporting it officially? Dr. Patil?
So see, as I said, the symptoms of the respiratory viruses are overlapping. Whether it's cold, cough, congestion, shortness of breath, whether it is the flu viruses like your influenza A, influenza B, swine flu virus, respiratory syncytial virus, or your parainfluenza viruses, the symptoms are very overlapping. There are very specific treatment for influenza viruses. For example, you have oseltamivir, also called as Tamiflu. So when you have evidence, I think you can better manage the cases. And when you know that for HMPV, you have to be careful in infants, in elderly, and those with immunocompromised conditions, or those who are taking steroids. So then, yes, it obviously helps in the patient management and patient triaging as well.
Okay. Same question to you as well, Dr. Sarkar, because, I mean, if this is a common cold and flu, we typically, when we go to the doctor, we don't test. I mean, we stop testing after COVID because there could be many, many viral strains. In this case, why the need to test, and what would you expect from the ICMR as well? Because that's when public sort of alarm bells also start going off. When you say case 1 detected here, case 2 detected there. So what would you expect from the ICMR in terms of just managing this from a public health standpoint?
So traditionally, it has been tested mainly in like immunocompromised patients and children, where there is a chance of a complication or something. Otherwise, in like adults, we generally don't test for these respiratory infections as a part of respiratory panel. But for immunocompromised patients or children, pediatricians can actually ask for this respiratory virus, where the common cold may get complicated and may cause pneumonia. This is where it has been traditionally tested this human metapneumovirus as a part of respiratory panel, not in silo. It has never been tested. It has never been practiced. So, and this is what it's currently being tested for. But now, at the current situation, also most of the labs, we also are well equipped to test this human metapneumovirus if there is any surge for specifically human metapneumovirus. Then we can also do that.
Sure, and just to confirm, like Dr. Patil also said, that there is adequate testing infrastructure available. If anyone is aged or young children, anyone who has some immuno disorder, for them testing facilities available adequately across the country, right, Dr. Sarkar?
Yes, it is available in most of the top grade labs in India.
Okay. All right, gentlemen, thank you very much. That's a very quick, brief, helpful insight that I think a lot of our viewers would also need in terms of just how prepared we are and where we stand right now. So you just heard two doctors there on the panel saying that, A, this is not a new virus. This has been around for a long time. What needs to be established is whether there is any mutation, any new strain that's come in which has different behavioral patterns than the virus that was discovered 3-4 years back. That's what the doctors have told us. And there's enough testing infrastructure in the country. And it's only traditionally immunosuppressant patients which have some sort of immunity disorder or low immunity. They are the ones who traditionally go for testing. So that's the situation and what we know right now. But with that, let's move back to the market, which is singing a song of its own, and it's a huge sea of red. Nothing has really changed over there. Gurmeet Chaddha of Complete Circle Consultants is with us. Gurmeet, well, very, very happy new year, though I must say, starting off with that wish, not on a very happy note with what the market's doing. I think the happy news is what the doctors just told us. There's nothing to really worry about with respect to this virus. But back to the market, what's your sense? It's just relentless, the selling pressure.
So I said this, I think the problem is more internal. It is not virus, it is not yen carry trade unwinding. The finance minister of Japan made a comment. It is not FI selling. I think the growth has slowed down, and I think the valuations are still rich. If you see the credit growth update of most banks, and credit growth is basically a proxy to your nominal GDP growth with very high correlation. I think that tells you that there is softness, and that's getting reflected in GDP numbers, in GST numbers, which came in December. So I think, and government spending has been very slow. So I think the problem is, to me, is more internal. Yes, there are issues which will come. Sometimes it is war. Sometimes these are health scares which keep coming. I think that's the world we live in. But I think the key trigger for us is earnings. I think we need to get a bit of a growth momentum back, because if your earnings growth is in single digit, despite the correction, 21 times still market is still relatively expensive.
Hi Gurmeet, Happy New Year. Good to see you in. Well, but what would you do then? Are you all sitting at the sidelines waiting for the dust to clear up, or are you gradually deploying? Because as you said, if it's the problems are domestic related, then earnings is not going to be as good as was earlier estimated. We're kicking the can down the road. It'll become the earnings season to look forward to will be FY26, which means the next couple of quarters will be a bit of a washout.
Hi Nigel. I think broadly there are pockets where either you feel the earning will remain resilient, or there will be signs of them picking up due to cyclicality. I think IT is one pocket. I think earnings will be steady. So you have to be mindful of what valuations you pay. So one obviously is the dollar impact. Second, if you see wage hikes are very nominal or getting delayed, and attrition issues have been solved. And long term, I think US also, whatever noises we are getting, is that they want more people to come to the right route. So there will be some positive long term changes even in H1B, in my view. And then obviously the tax cuts which Trump government is talking about, which benefits IT spending. So I think that's one pocket where you got to be more focused on, assuming you don't overpay. The second pocket we are seeing, which is saying a bit of a comeback, would be housing. And I think that that's one pocket where I think you see a bit of an uptick coming in. We have a union budget. You will see a lot of announcements, both in terms of SOPs for the sector as well as some more disposable income coming. And there are obviously government initiatives. So that's the second part. And third is, I think with now 3 months left, government is going to spend more to catch up with the 11 lakh crore target they had. So you will see large orders, large projects getting announced to make up for it. And that could come in power transmission, it could come in defense, We saw, the defense minister talking of this being a year of reforms and modern defense technologies. So you got to, as I said, focus. This is a tough year. You have to, it's not a year like 22, 23, 24. I think the money making will be tough, but there are opportunities.
Opportunities. You want to talk more about those opportunities in what is a tough environment. Gurmeet, hang on, just give us a second because we're looking at some of the big newsmakers of the day as well. And obviously, it's all about ITC. Let's look at the stock and see what it's doing. It was trading down 6-7% last I checked. This is obviously as the demerger of the hotels business is well underway, down about 8% right now, 37 rupees lower. We have Mangalam joining in. So this is the first leg, Mangalam. Now the stock is trading ex the hotel business. And then the hotel business lists next month, right?
Yeah, so if you look at the ITC stock price today, the cut that we've seen does not entirely reflect the market sentiment. A large part of that is by virtue of the 9 to 10 a.m. special session that took place today to discover the price of ITC hotels itself. So if you look at the opening price today and the closing price yesterday, you would realize that the stock opened lower by 26 rupees per share, and that's the value that the street believes it has ascribed to the hotel business itself. More analysts on the street were expecting this range to be between 15 to 20 rupees. But, if you consider this difference as the final value for the hotel business, as of today, then, it is a little higher than what the street was anticipating. The proof of this, however, will be the day the hotel business lists, which is somewhere mid-February, what the expectations are given the timelines that the company is given. Just to jog your memory once again, ITC Hotels has about 130 properties with 13,000 rooms, and the company is looking at close to around 180 hotels with almost 18,000 rooms by 2030, two-thirds of that being managed. And if you look at the valuations at which all the hotel stocks trade, the street believes that, ITC's place in terms of a multiple could be somewhere between Chalet Hotels and Indian Hotels, which is a leader, and at a premium to the sector itself at 37 times. But given the difference of yesterday's close and today's open, that 26 rupee mark, values the ITC hotel business at close to around 54,000, but that's an implied value. What we really need to look at is the listing of the hotels business that happens mid-February. If valuations of 26 to 28 times are something to go by, then that share could list anywhere between 175 to 190 rupees a piece.
Got it, Mangalam. So that's on ITC, but markets in red. You have got pink on your mind for personal reasons. Nykaa, though, is one of the outperformers today. Tell us more about that update.
Yes, Nigel, absolutely. If you look at some of the products in your house, you would realize a lot of them do come in from Nykaa itself. And that comes in from the growth that we're seeing in beauty and personal care, especially the premium end of things. The company has been calling this out as a mega trend. And out there, the net revenue growth for the company this time around will be higher than mid-20s. In a sector, the consumer sector, which is largely parched for growth, mid-20s is something that the street likes more so if it comes from the beauty vertical. So, the growth out there has accelerated. Remember, there were a couple of activation events that Nykaa did during the quarter as well. Even if you adjust for that, the net sales growth in the third quarter has been mid-20s. And if you add back those discounts and deals, then the gross sales would be over 30% itself. And that is something that the street likes. The part of the business which is growing a little slower than what the street anticipated it to grow is the fashion business. And that's largely because of the weakness that we're seeing in online fashion. That too is growing at around 20%. So that's a positive. And as a result of which, the stock's holding in the green despite the weakness that we're seeing in the market.
All right. It's all about self-love and self-care, isn't it?
GRWM,
That's what perhaps,
get ready with me is what they say.
I suppose. And Navin, that also explains that the story that our colleagues at Money Control did, right? Minimalist, which perhaps Lever is interested in, and nothing minimal about that price. I think 3,000 crores is what the numbers were that were doing the rounds, right? In terms of the size and price of that acquisition.
Yeah, so if you look at the size of the acquisition, 3,000 crores for HUL will not be as much because they have a lot of cash on their books. And more than just, the size of the business, they're paying for growth. So Minimalist, if you look at the revenues, last year grew by about 90%, and the profits more than doubled from about 5 crores to 11 crores. So if Unilever can scale that out in their own distribution muscle, and again, they too have called out the mega trend of premium skincare, premium wellness doing extremely well. So if they go ahead and do that, execution would be key for them, not particularly the price, but again, they're paying for growth and not just, initial value for Unilever and Minimalist.
Absolutely. Self-care. That's what it's all about. Thanks, Mangalam, for that. Let's actually discuss this with Gurmeet. Gurmeet, so it's very clear, right? The country is consuming, but consuming what? And that's evident in the Q3 updates. We were discussing Nykaa with Mangalam just now, but even Jubilant. I mean, Jubilant's done actually better after a long, long time. Titan's numbers were sparkling as well. And what is not doing well? I mean, your usual, Dabur is talking about single-digit growth. Marico's got good growth, but they're worried about their margins because of, raw material inflation. So how would you look at playing the discretionary consumer side of it, given that stock prices have already run up quite a bit in many cases?
So we discussed how the consumption basket itself is changing, right? So one of it is the digital consumption we are doing. So you've got to own some of the marketplaces. We're paying for literally everything: OTT, online groceries, online consumption on beauty and personal care, your health apps. Even the financial products you are buying, the marketplaces like Policy Bazaar. So I think the consumption basket, which is moving digital, is something which we should look at in your portfolio. The second is the high-end consumption happening in different pockets. Like airport has become a new hub for consumption, and that is aided by the increased budgets we are doing for travel. Now that whether it is religious tourism or it is domestic travel or it is international travel, so there are ways to play that, either through airlines or to hotels, or through some of the high-end retail like the luxury watchmakers, etc. And third is the awareness which is coming on organic foods and healthcare and becoming, and that is why products which have high sugar content, and that's largely I'm talking about urban. It's not as much rural, and that's where the consumption pattern is changing thick and fast. So the companies who are on that front, tends to do better. So even if you look at today, something like, let's say, a Tata Consumer which has Sampann, which is ready to eat food, hasn't done that badly in a market like this versus some of the other names. Even Britannia, for example, their portfolio, which is non-sugar and you call the health portfolio, the contribution is incrementally increasing. So I think you got to make that transition in your portfolio and look at companies who are doing that actively.
Okay, all right, Gurmeet, we'll leave it on that note for now. Thank you very much for joining us this afternoon. Look forward to another chat soon. We do have to take a very quick break. On the other side, we will be in conversation with Ajay Argal of Franklin Templeton, get their perspective on the market. Welcome back. So the market's still dealing with an ample amount of pressure, 370, 375 points down on the Nifty. There's been no real meaningful recovery, very small bounces, but then they've been sold into, at least as of now. Let's see. We've still got about half an hour to go to figure out how this day closes. We have our next guest joining in now. Ajay Argal of Franklin Templeton is our alpha manager of the day. Ajay, thank you very much for joining in. First of all, season's greetings to you. Wish you a very, very happy new year. Well, for Indian investors, it's been a bit of a wobbly start to the year. Time correction in some cases, price correction, and relentless FPI selling. So far, Indian mutual fund investors have kept the faith. Do you think they'll continue doing that?
Yeah, so thing is, the Indian domestic mutual fund investors, they've seen very good returns over a long period of time. They have also kind of matured. They kind of are looking to buy or increase their allocations on every dip. And of course, that confidence has come because the returns have been good. So as long as the returns are there, the flows are likely to continue. Of course, as we have seen in the last few months, the returns have been tepid. So if this returns being tepid continues for a longer period of time, say 1 to 2 years, then it would be interesting to watch what the reactions of the domestic investors would be.
Yeah, but I guess that's the critical question, right? Whether
Yes.
they can continue to stay invested even if there is a period of low returns or maybe no returns. But Ajay, let's get to the house view. I mean, on equities here, Indian equities, what's the call? A lot of people are calling for maybe just single-digit returns this year. What's the general stance? I mean, what's the house call, and what is the sort of construct with which you're going right now? More defensive, or you're looking for bargains in sectors which traditionally did well in early 24, like capex, like EMS, etc.
Right. So the construct is that we are in challenging times. So as we have been witnessing, there is a bit of a slowdown, and it is across sectors. And initially, it started off with few sectors, and now it's kind of spread to many sectors. And then we have seen the GDP growth itself hit the 5% handle. And it is kind of reflected in the earnings as well. If you look at the first half of this year, the earnings growth for the top 500 companies has been almost zero. And therefore, the earnings downgrades have happened. And now we are expecting like kind of single-digit earnings growth for FY25. And that itself might be a bit of a challenge, as you were highlighting, whatever the initial outlook from a few companies in consumers have come and a few banks have come, it doesn't look like there is a major pickup. So there is this kind of reality check which is happening with the kind of growth which we are having and the valuations which we are trading at. So the valuations are definitely not kind of anticipating the kind of growth which is being currently witnessed. Basically, they are on the higher side. And of course, the valuations for some of the pockets in the mid caps are extremely high. So as far as the constructs of the portfolios are concerned, we are taking all this into consideration. And we have always been bottom up, so stock specific, but this is the time where you need to be more stock specific, because the sectoral trends are not there across most of the sectors. It is not as if you can generate alpha through sector selection. So you need to focus more and more on getting the right stocks. And that's what our focus are in terms of market caps we highlighted. So in our diversified strategies, whether it is focus fund or flexi cap fund, we are having larger weightage towards the large cap. So that is one construct of the portfolio we are having. And then, of course, we are looking at stocks where the balance sheets have been strong, where there is still some semblance of growth. And at the same time, they are available at some reasonable valuations, because some of the stocks which we have seen in the last couple of years, when they were doing or growing very fast, they were kind of trading at much higher valuations. But now that valuations are being questioned very rigorously, if at all there is some disappointment on growth. So more focus on the growth versus valuation combination.
All right. Hi, Ajay. Good afternoon and good to see you, Ben. Nigel on this side. Ajay, it's sounding like it's going to be a difficult year. What would it mean, though? A time-wise correction? Or should we brace ourselves for a larger negative year in terms of returns? Because for the last 6-7 months, actually, the Nifty has gone nowhere. In fact, we're a little bit lower. So if you could define difficult year. Yeah.
Good afternoon, Nigel. And you're right. We believe that there is a bit of overvaluation with respect to the growth which we are witnessing. And if you look at the Nifty itself, the overvaluation might be 10 to 15%. But if you look at the mid-cap especially, the overvaluation might be much more. So the overvaluation obviously can get corrected in two ways. It could be actual price correction, or it could be a time correction. Now, you are asking a very billion-dollar question whether which one of these would be the case. I don't think anyone can predict with any certainty whether it will be actual time correction or actual correction, or whether there will be a time correction. But we feel that there has to be a correction. So if you just go in the recent past itself, October 21 to March 23, 18 months of period, there was no returns. So it is quite possible that we have that kind of time frame, or maybe even a bit 1 or 2 quarters more than that, where you don't have too much of returns. But one thing is clear to our mind, that the returns which we have witnessed in the recent past is not likely to happen. So the investors need to tone down their expectations. But at the same time, and this is going back to the initial question, that how do the domestic investors react? The options for the domestic investors, equity remains the best option from the long-term perspective. If you have a 3-year plus view, then the kind of returns which you get, and especially on a post-tax basis, is going to remain the best in equities. Even with a slowdown, we are seeing a 5-6% growth, or that is about 10-11% nominal growth. And typically, over long periods of time, you get returns which are in line with the growth if the valuations are reasonable. And if the valuations are not reasonable, which is the case at the moment, we might have some bit of longer time frames to get the same kind of returns. So what we might be expecting a return in, let's say, 5 years, you might get it in 6 years. So that kind of situation may happen.
Yes.
But equity markets still remain the best opportunity for returns. Yeah.
Got it. Near-term pain, but longer-term gain. Tell us, Ajay, then, if you're in for the longer haul, then what could be that pocket where you could get reasonable valuations, good theme to play as well, and earnings will ultimately look up? What is that top theme that you all will look to play in this period of uncertainty?
Right. So the top theme we are playing, and we are kind of reasonably overweight, is the banking sector. And we have seen the updates from the banking, a few banks. And we have seen that they have kind of shown, or kind of indicated, between 7 to 10% kind of growth from the credit system perspective. And of course, we need to see how the margins would be. But the good part about the sector is that the growth is reasonable. There is a bit of a slowdown like other sectors as well, but it is still close to the double digits. There is a bit of hit which will happen on the asset quality front, but again, it will not be too much, because just few pockets like microfinance and a bit on personal loans, which anyway the regulator has kind of put some curves, and therefore the growth has anyway slowed down, and they're all short cycle. And what we are expecting is that the interest rate cut cycle will be at a slower speed, and it will be shallow. And in that scenario, the margin hit will not be much. So basically, the growth and the business performance will be very stable. And importantly, this is the only sector where the valuations are lower than the last 5-year averages. So this combination is very good. And we feel very confident that it will be one of the sectors which will do well in relative terms. Another sector where we are a bit positive is the healthcare sector. And where admittedly the stocks have already done well. So the starting point in terms of valuation is not as good as the banking sector. But it's still, we have a few opportunities, and this is more stock-specific opportunities rather than across the sector, where some companies, either they are in the specialist pharma space or complex generics, they have some good growth opportunities. The third sector is the real estate sector. In the real estate, we have seen that the cycle has turned, and the inventory levels are down to maybe 14, 15 months across the top 7 cities or so. And that is down from 40 months of inventory. So there is a substantial correction in the inventory levels. And as and when the launches come, which we are expecting starting from this quarter, that the launches will increase, the sales and the collections would increase, and that will further take up the growth prospects of the sector. So we are a bit overweight on this sector as well.
Okay, all right. We will leave it on that note. Thank you very much for joining in, Ajay, and we look forward to more conversations during the course of 2025. Thanks for being with us today. Well, with that, let's move on. It's time now for our special segment, D Street Chatter. What is the chatter today? What a manic Monday on the street. We have, of course, Nimesh joining in as always. Nimesh, as if Friday wasn't enough, now this Monday has completely eclipsed what we saw on Friday. What is it that you've been picking up?
Well, absolutely, Surbhi. And it has come as a bit of a surprise as well. Nobody was anticipating such a sharp sell-off Indian markets on the very first day of this week. So caught off guard to some extent. But again, the sense I'm getting is there is selling as well. We saw the selling pressure on Friday as well. The FI number was quite large. And looks like even today there is going to be a large, substantially large FISL figure. So that number would be quite important to track. I guess, globally, there are a couple of global triggers which are having an impact on most markets in India as well. One, of course, is the currency move. We extensively discussed that throughout the day. And second is the central bank action. There is a lot of concerns about what, maybe what Japan central bank will do and what impact it can have on the currencies and on global markets. So again, that's something which is weighing on the sentiment in the Indian markets as well, and that's added by the FI selling pressure. I guess technically we're back to very close to that crucial support on the downside, which is 23,300. I've been saying this, that the Nifty seems to be in that 1,000 points range. On the upside, 24,300 is acting as a very strong resistance, and on the downside, 23,300 is a level to watch as a crucial support. So that's something to track. From a sector point of view, financial has been a big underperformer today. Again, the Q3 has not gone down so well as far as the updates are concerned, and that's the reason why the bank Nifty is up almost 2%. But surprisingly, there is selling across the board today. The broader markets have been under pressure as well. The Midcap index is down 2.5%, the small cap is down 3%, and looks like there is selling across the board. So a bit of unwinding as well from the retail and HN investors in the broader market. But largely it's because of the global cues and the fact that the FI selling has intensified again. That's adding pressure to the Indian stocks and broader markets as well.
Indeed, Nimesh, a rather weak trading session. That FI number we look out for. But what about individual stocks? What are you picking up?
So in terms of individual names, Nigel, the first stock is Marico. Well, the update was quite strong. The stock is under pressure today, but I understand there's going to be a small MOC buying as well in Marico in today's market. So that's something to track from a flow perspective. The second stock is Zomato. Under pressure for the second day running. There are aggressive sellers is what I understand. And looks like some larger FI seems to be active sellers as well in Zomato. So that's the reason why that stock is relatively underperformed for the last couple of days. And so is the case today as well. The third stock is Sequence Scientific. Well, the stock has been consolidating. I understand there could be a corporate development very soon. The city is anticipating some inorganic move by the company very soon. So that's a trigger in Sequence Scientific. And the last is Transrail Lightning, a recent listing. Since listing, the stock is up 20-odd%. Huge volumes in the last couple of days. Even in today, in a weaker market, that stock is buzzing in trade, largely on back of strong HNI flow. So some HNI action seems to be quite active in the recent listing, and hence Transrail is buzzing in trade today.
Okay, all right, Nimesh, thanks very much for joining in with all the updates today. We do have to take a quick break right now. We'll come back on the other side and get you more on the markets in just a bit.
Welcome back. Well, we are back at the low point of the day. Mitesh Thakkar is back with us. Mitesh, your view on the index. if you had a short position, what would you do? Where does support come in? And also fill us in with a couple of your picks.
I think carrying the short may not be a bad idea. So we are quite down today, and there's always a chance of some kind of gap up opening, but the structure is weakened considerably. So I think this is a slightly positional view. One, I think the Nifty is very likely to test 23,350, maybe break below that. Similarly, the Bank Nifty bounced back from 49,700 zone, which is where the Bank Nifty had made a low in August of 24. But looking at the indicator position and the moving averages, I think once we start breaking below this 49,700 levels, I think good chance that we are penciling in about 1,000 point plus cut more in the Bank Nifty. So stay short. Having said that, I have two STBT calls. One of them is BHEL. Sorry, one BTS and one STBT. BHEL is an STBT with a stop at about 222 for targets of 214. And SBI cards, I think that's on the buying side. Disclaimer, we have some call option positions, so there's vested interest. But SBI cards is doing well in this weak market. It's come off the day's high, but yeah, the structure is good. So BTST here with a stop at about 722 for targets of 740.
SBI cards is the buy call and the sell call is BHL. Is that correct?
That's right. That's right.
Thanks, Mitesh, for that. Well, diagnostic companies, that's the bright spot today. We have a couple of updates, brokerage notes as well coming in. Vinny joins us to help us out to tell us why Dr. Lal and Metropolis both are doing well. Vinny.
Yes, so we have both these stocks today in focus. Let me start with Dr. Lal. We had a brokerage note that came in from Kotak Institutional Equities. They upgraded Dr. Lal to an add from a previous reduced rating that they had. They've gotten a target price of 3,250 rupees per share for Dr. Lal Path Labs. Now, what are they saying is that the execution has started improving. That started on track for the company, and that is a strategy which they want to follow in terms of improved execution, which is working out well. Other than that, they're expecting gradual improvement in terms of the transition that is taking place in leadership. That will be starting to support the growth in terms of strategies that they're putting in place. Pricing action, that's a key to watch out for, right? We've seen those increased competitions coming in from the online channels and online diagnostic companies and pharma like Tata MG, or even when you look at it in terms of Redcliffe, these are the companies on online and offline channels which are creating some bit of a competition for these companies. So now in terms of pricing strategy, pricing action has been taken across most these online and offline players as well. So that means the gap between the pricing has been reducing, which turns out to be a positive for them. For Dr. Lal, they're expecting a volume growth to see a steady pickup in the suburban areas as well as in terms of the tier 3 and tier 4 cities, which will be supporting Dr. Lal's growth. So yes, keeping an eye out on Dr. Lal. Now moving on to Metropolis Healthcare. Metropolis Healthcare reported its Q3 operational update. Good growth in terms of update, double-digit revenue growth of 11% on a year-on-year basis. Other than that, volume growth has also started seeing an improvement, plus product mix is something that is supporting the growth. B2C revenues have seen a 15% growth. They've spoken about increasing the prices in Q4 FY25 in some of these B2C cities. So yes, keeping an eye out on Metropolis also, indicating that the pricing gap is reducing between these platforms as well as these online channels. So that is an interesting one to watch out for.
Okay, got it, Vinny. So those are the key triggers for these two diagnostic stocks, both of them in positive territory. Actually, even Thyrocare surged some 12% today. In any case, I suppose some sentiment rub-off because of the worries around the latest virus. Well, with that, we'll take a quick break, come back with more market talk in just a bit.